Well, that's a wonderful introduction. Thank you so much, Jeff. The way these things work is just like 40 years ago when my investment professor at Stanford Business School reached out to Warren Buffett and said, could you come by and give the students a sense of what you think about as an investor? So too, it happened with George and me. And as I was so impacted by Warren's visit to our classroom that I've made a note in my schedule that says, if you have a chance to speak to a class of people who have self-attributed to having a passion for investing, taught by a passionate professor about value investing, and you have a chance to convey some of the points that I was lucky enough to hear early on from Warren in our class, 40 years ago, you should probably take advantage of that opportunity. Hence, I'm here, sadly, for as short a period of time as you suggest. But I would love to, at the end of this meeting, leave you with very, very simple thoughts. And I think the thing that we spend most of our time focused on is this inevitable trade-off in investing, which is how much pain can you take today for gain tomorrow? And Wall Street is uniquely set up not to have near-term pain. The goal by Wall Street analysts, the goal by corporate officers who depend on Wall Street analysts, the presence of stock option grants which expire, so they have a good till date on them, and so they create a requirement that upfront pain is avoided as best as possible. But if anybody's ever run a private family business, they would know that the best returns come as a result of their willingness to risk what they have when they make an extension investment that will disrupt the current results, but it does so with plan to expand the business down the road. Near-term pain for long-term gain. Wall Street is completely set up in an opposite fashion, and it leads our businesses, which I think for a variety of reasons we'll get to have a great competitive advantage, because if you do have the ability to invest for the longest term at the costs of the near term, if you have the capacity to suffer Wall Street censure for doing that, you have a huge competitive advantage, because your competitors are trying to meet quarterly numbers and they're under-investing, and they're anticipating revenues, and they don't report expenses if they're too close to the end of the quarter and all that stuff, and it really erodes business. I was saying this to someone recently, and one of the participants in the gathering raised his hand and said that he had worked at the time Hewlett-Packard. And he said my comment struck a chord, because he remembered so many times when the quarterly call would come down to the branches and said, we have to cut expenses, because as we near the quarter, we're missing our numbers. So go back out, whatever you're thinking of spending, stop until later. And of course, they were thinking of spending when they were, because that's the right time to spend it. And if you don't spend, or if you wait to spend later, it's not going to develop the same competitive advantage. So it's a very simple Aesop's fable, two in the hand versus one in the hand versus two in the bush, and that's really the heart of value investing. Let's see here, I'm going to look for some assistance on the AV. Is there a advancing wand here? Let's see. Oh, good. I'm going to...
Let's see.
That's very good. That's very good. Okay, well, let me go. Oh, no. There we go. Okay, good. Anyways, I'm a long-term investor. This is a photograph in humor. My wife and I were in a safari during the worst time of the market. I think it may have been '08, and we were in the middle of June. The markets were in free fall. Every day we'd get up and go out to look for the big five on safari. And every time we'd see an animal, the guide would say to us, look, if you come upon one of these animals and you're out alone in the woods and it charges you, stand perfectly still and let it run past you because it won't chase you. So long as you stand still, you'll be fine. And they showed us that for a dozen different threatening, menacing animals, including scorpions or whatever else. And we came upon this one finally. And he said, if you ever see this one charging you, run like hell. And of course, the problem with that is you can't, until it's right upon you, you don't really know which it is. And so in our world, markets are volatile. We tend to buy and hold. I would say that in that period of time, we came very close to having a more actively traded mindset. Culture, this is what I was referring to, bird in the hand worth two in the bush. It's in the investment business, you want to play for more later, and you're willing to give up what you start with to do so. In my field of investing, corporate culture is terribly important. The ability to have your management represent your interests rather than their own is extremely important. And I was struck by this picture at some point with a Nestle CFO who had been the country head in Japan. And he admired this picture, so he shared it with us. And what he said is that temple, how many of you here are from Japan? Maybe you can prove me right or wrong, but he said this temple was 700 years old. None of the wood was, but this temple was. And that's very strange to think about, because what it means is that the whole thing's been done over half a dozen times because of the aging process. But when they put it back together, it shares the same value, it has the same look, and it stands for the same principles. And that is what we're looking for in the businesses that we own, because they require management to run them. That's a different requirement than what Warren Buffett had trained with and what he started with. And so when I saw him in 1982, I saw him at a really interesting seminal point, because he had gone from, just at that time, he was migrating from cheap 50-cent dollar bills to investing in businesses that had a franchise value. And up until then, a 50-cent dollar bill seemed pretty attractive, just so long as you could close the discount in a fairly quick hurry. Because in that investment scheme, if you buy a 50-cent dollar bill and the discount doesn't close for a decade, as they often don't, your compound is only 7%. If it closes the next day you buy it, of course, it's 100%. But time is not your friend in the investment world. That was historically the value investment approach. The margin of safety in that world was the fact that you're only paying 50 cents for a buck's worth of goods. But when I met with Warren in 1982, the margin of safety from his perspective had been migrated over to a business franchise. The quality of the business franchise is the margin of safety as opposed to the price paid. And that had surfaced in Berkshire's experience through See's Chocolate, one of the first businesses he bought, and it was bought based on the belief that people were loyal, extremely brand loyal to See's Chocolate, and would pass on any other varieties and would pay up each year. They were price inelastic in their demand because they didn't think there's an adequate substitute. We search the world for businesses where the consumer is willing to pay a higher price and not flinch, because if they weren't willing to, then you'd be in the world of commodities. If the consumer felt like See's Chocolate was just no different than Lindt or no different than Hershey or no different than, they wouldn't command the price. And without commanding the price, they wouldn't have the margin. Without the margin, they couldn't develop more returns from investing back in the business. So we look for businesses that have very strong brand awareness. And that was what, when Warren came to our class, he had just made that migration from old-fashioned value investing based on price paid to a look at the business's capacity to compete based on the strength of a brand, where the brand stands for the consumer's mind, the lack of an adequate substitute. So the two most important lessons that Warren shared with our class was first, that the government only gives one break for investors. That's the non-taxation of unrealized gains. So if you can do it, you'll leverage your own return. So for example, the shares of Berkshire that I bought in 1982 after seeing him come through for $1,000, today have $99,000 worth of interest-free loan from the government, because we haven't sold those shares, and that extra $99,000 is the amount of taxes you would have to pay were you to sell the position. Now, the beauty is we don't feel like there's any particular need to sell the position because the reinvestment opportunities going forward from here are fully sufficient to justify the share price today. And so it's amazing to think you can make an investment. This is sort of what got my own particular interest going. When you think of an investment that costs $1,000, 35, 40 years later is worth $330,000, and you think it has the ability to compound going forward off that with an open mandate, that's pretty exciting. And my own personal background, I grew up in the Midwest. I grew up in Wisconsin, and in a place much like this. And I always say of the investment process that I'm far more like a farmer than a hunter. And I mean, we've been farming our Berkshire share, one share, for 35, 40 years. And we didn't have to do anything else. Every day, Warren went out and plowed the fields and delivered more bounty, and the thing's gone up. But we have absolutely no interest in chasing down something that runs faster than us and that will likely not be able to fail. We just as soon farm. And the beauty of it is you just attend to that. So the first point Warren made was that you want to find businesses that have the capacity to reinvest, so that once you buy it, it will in fact start to grow, and that embedded gain then is what you're actually investing for, is the unrealized gain. What do you need to have the capacity to reinvest? In my world, I've specialized in the consumer, because I believe that the power of brands provide pricing power, and I often think about what businesses to spend time with. I think of those businesses that have developed dynastic fortunes, and you can think about brands like Marlboro or Heineken or Jameson's or Johnny Walker, or any number of things, and they've made permanent wealth because once the brands become iconic, they have a recurring demand. In fact, there's a wonderful thing. How many of you are from India? Raise your hands if you're from India. And then what would the standard duty-free purchase be on return to India?
It would be alcohol.
Well, in the world of alcohol, I mean, it's one brand, isn't it? Isn't it Johnny Walker Black Label? And it's iconic. Anyways, so we the capacity to reinvest is that around the world, consumers are only now beginning to have affordability, that they have consumer disposable income. That's the byproduct of the growth of the developing emerging markets. And so we are designed to have a portfolio, with our portfolio of international brands, to encourage our managers to take the cash flow from the mature markets of our international companies, think about a Unilever or a Nestle, and encourage them to plow as much as they can into developing the emerging markets, so that as the consumer in those markets develop more spending power, they will go back to brands that they've been aware of as part of their environment for generations, but they just haven't been able to afford the products. And so it starts as simply, for instance, in Nigeria, where 25 or 30 years ago, Nestle introduced bouillon cubes under the name Maggi. Well, they started by selling 1 cube at a time, and they built factories to have the capacity to serve that market. Well, they quickly proved that the market, as it grew in affordability, people bought more than one, they bought two, and suddenly the business doubled, they bought three, and it tripled. And they're out of capacity, so they have to build a new factory. And the moment they put that new factory up and running, it doesn't run at full absorption. And so their margins collapse for a while, but then it fills back up. And our job is to encourage those managers to make that type of investment so that they're ready for the consumer when they come calling with products like One Bouillon Cube and the other things that the consumer leads with. So the capacity to reinvest is that you have brands that have aspirational appeal. The frame of reference in investing in the world of brands is that people very often like other people to know who they are by what they have, what they consume, what they wear. And so it's so fundamental, so deeply felt allegiance to brands that people have that is what I think gives us as investors the ability to find businesses that have very long reinvestment cycles and allows us to do what Berkshire said is from the start, find a business that you can own now, and since it has reinvestment opportunities, will advance in size over time without having you to pay any tax on it. Other forces that are valuable for reinvestment is population growth. Well, that's all about emerging markets. Consumer disposable income growth, that's what happens when the families come in off the farms and they move to cities, and suddenly they're working in cities, so they have disposable income, and the two spouses work and all the rest. When I say that we're looking for companies that have global brands, we really mean global companies. And so 75% of my portfolio is invested in businesses like Unilever, Nestle, Pernod Ricard, and they're internationally based, mainly because they don't exercise stock options as much in the mix for compensation. And without having that stock option leverage, the investment horizon gets to be stretched out because, as I said, the problem with stock options is there's a good till date on those. And so it puts a pressure on when things work. And the best investments often exceed the horizon of stock options. So we tend to own international companies that have that reinvestment, in part because of the option-free zone, in part because historically, most Western investors are not particularly keen on the prospects for Europe. Europe seems a bit sclerotic and it seems a bit tired, and so investors fail to look through the companies that we have and realize that through Nestle or Unilever, you're actually investing deeply in emerging markets, but you're doing so at lower prices because the investment world doesn't really think that the European market's going to be very productive. It's despite Europe, rather than because of it, that we have the companies. And the European trademarks are actually what made the businesses appealing in the first place because of the stature that Europe has long enjoyed. So capacity to reinvest. In our portfolio company, the other thing you have to do is you probably want to have globally adept management. So, for example, how many people in this room speak more than 4 languages? 3? That's pretty good. Here, look at this, and then 2. It's extraordinary. Yeah, it's extraordinary. But you won't find that at the Kraft Foods, they speak 0.9 languages. You just don't find the same kind of capacity. That's if you want to be effective internationally. The other thing, you have to be multicultural in addition to multilingual. And to get that, how many people here, raise your hands if you have a favorite cricket player? Again, the same people. But the fact is, most Americans don't even begin to know the meaning of cricket, and that 1.8 billion people will go to bed tonight thinking nothing but great things about their favorite cricket player. Now, in a company like Nestle or MasterCard's run by Ajay Banga. He grew up in India. Of course, he speaks 3 languages, has an extraordinary global Rolodex. We couldn't be happier than to have 11% of our money managed effectively by one of the most extraordinary leaders in business today, who's Indian and manages to move around the world with extraordinary balance. So Those are some of the ingredients that help with the capacity to reinvest. By the way, I can be interrupted, so if anyone is pressed with a question, just raise your hand. I think it may liven things up, and I'm happy to respond. So,
I have a question. Talking about entry price.
Yes.
So you had talked about your competitive advantage is kind of like the new margin of safety.
yes.
At what point do you find that prices can be over, like out of your range, or they fall within it so that you feel like you can jump in? Like, how does that work?
Well, the pricing mechanism and discipline is still very important. So, you really have businesses that your perspective about what the growth possibility through reinvestment looks like is different than what the market ascribes it. And I find that we end up more comfortable with probably slightly higher prices than deep value investors because of our belief that we know what years 10 plus look like. Where, if you're only kind of certain on the years 1 through 3, and then you make a couple of assumptions in year 5, and that's the end of your exercise, you're going to come up with a different valuation than we will, because we actually, I think, add value in identifying those businesses that years 10 and beyond are the most promising. I'll give you an example of Heineken. When we first invested in Heineken in 1986, it was 15% exposed to developing emerging markets. It had 70% of its business in sclerotic Europe, and something like 10% of profits were from North America, which is the high-end premium. That's almost 40 years ago. Over those years, the family-controlled Heineken expanded again and again and again. And I invested in it as early as 1986, strengthened as I was with the belief that in their unique situation of being the world's preeminent brand in beer, and also family-controlled, that they would have a platform from which they could make investments without risking their independence. And that enabled them from the outset to be a much more forceful acquirer and builder. And so over the years, they were at the same time at the start, they were less discovered, so they were cheaper. The shares that I owned first in Heineken in 1986, I think we paid 8 times earnings for them, and they're now 19 times earnings. So the world's changed. Mind you, the interest rate in 1986 may have been 12%. Today, the interest rate that's comparable is 3%. So you've got all sorts of forces going on. But the real trick with Heineken is that they kept extending their capacity to reinvest through one acquisition after another, and the price has moved along as it has, and we see their ability to continue to deploy capital well out beyond 20 years. And so, though some will have come along for parts of the investment performance that has been enjoyed since the start, most leave because they meet an interim price target that reflects a view of something that's going to happen in the next 5 years. And our difference is that I think we're much more ratcheted down on what happens 10 to 15 years out. And that gives us more, I think, staying power and more comfort. And at the same time, we have taxable investors largely, and to the extent that a sale would trigger the tax on the embedded gain, out goes the funds that we're investing sort of rent-free by the deferred tax. We think hard about whether we make up the tax paid. If it's just a function of the valuation, we may weigh the tax consequence a bit as well. So the capacity to reinvest, you have a series of features. The real thing that distinguishes the businesses that we own, though, is in the investment process, that our managers have something that most public companies don't, which is the ability for our managers to invest with an eye towards very long-term performance. And those investments come at the expense of near-term results. And most companies would love to have that capability, but they don't. Family-controlled companies do. The Heineken family controls Heineken. They had the ability to allow all of those investments to take place, and Wall Street's reaction to investments along the way is often harsh. The shares price would drop sharply when they did things along the way, and they did so impervious as management to the risks of losing their job or losing control of the company because the family controlled the company. And having that capacity for management to suffer through downgrades and through the possible pressure from corporate activists and all sorts of things that's protected of them by virtue of family control, they've just been much more effective in investing for the future because they have the capacity as management teams to suffer from the near-term pressure. And we'll have a couple of examples. But the summary basically is you need to have the capacity to reinvest. You also need the capacity to do it with the Wall Street pressures that companies feel. And the last thing I would say is that's added enormous value in my career has been the ability to do nothing for vast periods of time. It's really underrated. Holding in the portfolio that we'll look at later in the slide deck, I think more than half of them I bought in the 1980s, and they've delivered a compound because of the reinvestments that has been allowed to take place along the way. Heineken is a good example in terms of how the capacity to suffer story plays out. And Heineken's Brazil moves recently are a perfect example of it. 5 years ago, the second largest Brazilian brewery was up for sale. Brazil's dominated by Ambev, the Brazilian company that's run by 3G. And that business was for sale. And the ability to suffer, which is, I say, what's so important for our managers, it expresses itself two ways. In the one hand, it is that the management teams have the ability to say no when Wall Street clamors yes. And the other expression is that they have the ability to say yes when Wall Street clamors no. And this example kind of puts them both together side by side. So at the start, 5 years ago, Wall Street implored Heineken to pick up 15% stake in Brazil because they had a 15% stake. And the idea would be how nice to fit them together and get them going. And so Wall Street pounded on Heineken to go ahead and buy it, but when they looked at the books and they went through the auction process, Kirin, in fact, the somewhat lethargic Japanese brewery, bought it for $5 billion. They bought the business that was for sale in Brazil. Heineken was reviled by the analysts. The shares were pressured because they didn't comply and all the rest. But they said, nope, it didn't make sense at that price for them. Now, 4 years later, it turned out that the Kirin people made a real mess of the thing. And by 4 years of ownership, they were losing money at the EBITDA level. And so they came back to the U.S. and offered it for sale. Now, Heineken was demanded by the analysts. They don't even think about going near it. Don't touch it. Don't even look at it. It's negative EBITDA. Heineken took a look and said, we'll take it. And they bought it for $660 million. So the business that they were implored to take for $5 billion, they end up being employed not to take it at $660. That's where we are today. Now, there are reasons behind all of this, and one of the reasons is that once the dust closes on the deal, there's a lot of work that has to be done. They have to reorganize their distribution network. They have to reset the brewery footprint. They have a lot of work to do. And that work is going to disrupt earnings per share. And no other company had the ability to go in and take on the next step, which will be very divisive towards their earnings per share outlook for the next 2 or 3 years. I could care less about it. And the good news is that Heineken cares less about it because after they did the deal this time around, Wall Street was sufficiently perturbed that the shares came down quite sharply. And SAB Miller came along and tried to take over Heineken during the period when the share price reacted negatively because of the disappointment that they didn't follow Wall Street's advice. And the family said no. And they had 50.1% of the vote, and they were able to defeat a takeover offer. Now, that same takeover offer for any public company without a control shareholder would have been the death knell. The management would have been sacrificed. Now, having the power to do something like this means that they have great competitive advantage. against those people who don't have the ability for their managements to suffer the kind of abuse that this company suffers from Wall Street when they take on a big deal like that. Weetabix, I once owned 21% of Weetabix. How many people here know what that is? It's a inedible British sponge that, no, it's inedible. My wife's from England, so I know what it is. It's inedible, and it's a sponge. It was a profitable sponge, and I'll just show you the slides here. That may just not be legible anymore, but I hope it is. So here's the deal on this one. If you look at the far right, we basically bought the shares at half of its intrinsic value at the time. If you used 8 times EBITDA and then netted the debt from cash, added the cash value. On the far right column, there you'll see that it was worth what does it say, $11.30, and we paid $5.95. Family-controlled company, so they had the ability to say no when Wall Street told them yes. They were pressured countless times to make acquisitions, but instead, they knew what the business was that they were in. They innovated around their business to try to create something that people could eat. But the upshot was that cash, which is about 3 lines up from the bottom at the top section, cash just grew. And it grew over the period of our holding to 103, let's just take a look here, $103 million. The EBITDA grew quite sharply up until about 99 when it started to trail downwards. And the share price went up 5-fold. And then during the internet bubble, it started to go down again. But what you'll see here, I hope on the next slide, you'll see the growth in the intrinsic value per share. And then what happened at some point around in the period around the internet bubble is people just stopped caring about bad tasting British cereal. And the shares slipped. The intrinsic value continued to grow based on the multiple EBITDA and the cash that was mounting in the firm. Now and then it all came together at the end when it was taken over by a UK-based private equity firm that thought they could actually sell the product in other countries. And of course, that was a mistake. It subsequently made the rounds, but it was when you say the manager has to have the capacity to suffer, I can assure you that during the period of time when Weetabix shares went down so sharply, even though the intrinsic value went up, it was nearly impossible to keep the position in our firm because any American who had any curiosity at all, when they see that we own 21% of Weetabix, would try it. And they'd come back and say, this thing's like a sponge. And I'd say, no, it's virtuous and all the rest. And then the price starts to go down, and you have absolutely no credibility. So, but it all worked out well in the end. Interestingly, if I can go back a slide, that's all screwed up. Oh, my God. Now we're really in untrod territory. I have to go. Oh.
Go left. Go back.
One more?
One more.
2 more? One more? Keep going, keep going. That's it. Okay.
So this one's a go forward, this one's a go
Oh, thank you. Okay, so this one, the only reason I came back to this is that one of the things that you see, a family-controlled company, in this case, look at the separate line, 5 lines up from the bottom, and it'll show you the number of shares outstanding. Now, this business thrived over the period of time. They had great workers and all the rest, but they didn't give away stock options. And so along that whole period of time, the shares outstanding were 11.2 million. And so that was a plus, and that's something that private families are far less likely to give away stock free like that. Unfortunately, at the same time, since they didn't have very many shares outstanding, most of it was still held by the family, the one thing they did not do is take the $103 million of cash towards the end and buy back shares at, a third of the value, intrinsic value, which they could have done towards the end. If they had, instead of getting $52 a year, pounds per share, we'd have received something closer to 100 because of just buying back the outstanding shares before the transaction took place. But they were disinclined to do that, and it was sufficiently profitably even despite that. Berkshire's the best lesson of all for how you can figure out what it means to have the capacity to suffer, and Geico's a great example of that. Geico is a business that when Warren bought it, he thought it had the best prospects and should be the most popular insurance company for cars, and it only had 1 million policyholders, 1% of the market. And the reason is that growth destroyed, in this business, destroyed reported profits because every new policy that you engage in the insurance business, car insurance business, loses money in the first year because you absorb all the costs associated with putting that business on stream, and you end up losing $250 per new insured. And in Geico's case, when he bought it, they had 1 million policyholders, and they were making $150 per policyholder that was mature and active. So they were making $150 million when he bought the company. And he wanted to grow it fast because he thought it was a business that really the market deserved. But the trouble is, if you think about the model, every new policy you put on the book has a negative $250 impact in the first year. And at the same time, it has a $2,000 lifetime value for Geico because the insured renew so heavily, and they have relatively favorable loss experiences. At least they did up until texting and distracted drivers have caused trouble. But if you think about the math, and this is try to follow this, they're making $150 million on their mature business, and they have 1 million policyholders. If they wanted to grow the next year by 1 million policyholders, what would happen to reported income? What's that?
It would go down by 150 million?
Yeah, it would go down. It would go down to a minus 100 million, because they were still earning 150, but the new vintage crop, causing them 250 million of losses, would take away the 150 million of profits and actually show them as loss making. Now that is something that nobody can absorb except Warren Buffett, because he doesn't care about reported profits. He cares about intrinsic value. And if every new policy you put on the book has $2,000 of lifetime value, and you can do it for the mere cosmetic operating income burden of 250, that's a trade you're supposed to do all day long. And if you fast forward till the present, Berkshire has taken the number of insured at Geico up to now 14.5 million. They were up to about 12 million a couple of years ago, and Warren wrote it up, and he said in the annual report, because he's a very quirky guy, for some reason he thinks that his shareholders are his partners. And for some reason he thinks that if they're his partners, then he actually has some kind of obligation to help them understand what the value of the business that they share is. And without disclosing things that he shouldn't because of the SEC information requirements, he's perfectly willing to periodically lob something up like he did with Geico. And he said, because of the growth in premium insured that we've enjoyed since we bought it, Geico's worth $20 billion more today than it was when we started. And that's exactly 10 million new insured times 2,000. That's 20 billion. And so that's how the math worked. Now, it would have stayed, growing at 3 or 4% if they didn't latch into the Berkshire universe, where investment spending is something that they're perfectly comfortable to make. Now, you think that the lesson is well enough learned, but even the start of last year, when there were hurricanes and floods and earthquakes and so much damage took place in casualty year 2017, Berkshire's competitors in the car insurance business stopped writing new policies. They ceded that business over to Warren because they already, with the losses that they had suffered, didn't think that they could take on any more burden, even though that reporting 250 is really just accounting of the upfront costs. So The crazy thing is that even this past 18-month period, I think we picked up another 2 million policyholders. And that's simply because people let them go because they didn't want to burden already burdened income, even though it would deliver such a high intrinsic value to the business. I'll stop. Any questions? Any thoughts? Yes.
I think it's better to finish your presentation.
Yes.
We got the mic there.
Oh, good. All right. I'm gonna fast forward to Philip Morris and to their capacity to reinvest in a product that they spent $2 billion researching. That's that funny-looking thing coming out of the guy's mouth, and what that is called IQOS, and it's a heat not burn tobacco device. And it delivers exactly the same amount of nicotine that a cigarette does, which, by the way, is not the case for e-cigarettes, which deliver only 2 parts of nicotine, whereas a combusted cigarette, delivers 19 parts of nicotine. And that's part of what the consumer looks for when they smoke. So an e-cigarette at 2 parts is not going to convert many people permanently because they crave more. The IQOS delivers 19. So the other thing is it delivers tobacco flavor, whereas the e-cigarettes don't. They have fruit colors and all sorts of weird stuff. But so this thing is able to serve the smoker who wishes to quit so that they don't suffer from withdrawal from nicotine, which they want, and they don't miss the tobacco taste, which they like. It's the equivalent of continuing to smoke, but it's the equivalent of quitting at the same time because they lose 95% of their risks by not having combustion. Anyway, so the interesting thing about the story is that while Philip Morris International was spending $500 million a year for the past 4 years, their competitors were effectively spending nothing and sourcing kind of second-rate, poorly constructed, and ultimately not successful products from Chinese developers. So now, if you're Philip Morris, and you realize that over those same 4 years, you had the period of the strongest dollar appreciation. And Philip Morris is a U.S.-based company for whom all of the profits are earned internationally. So they are the most poorly positioned tobacco company in the world with the rising dollar because they make all of their money in India or in Indonesia. They bring it back to U.S. dollars, and the dollar soars means that the profits that they've made are understated. So at the very moment in time, over the past 4 years, when the dollar rose the most and their earnings were already the most suppressed, on top of that, they came into the marketplace and spent $500 million a year to come up with this product. So I commend them for that because that is real suffering. And mind you, as managers, they do have stock options, and the stock options and all their executive comp vest relative to total shareholder return comparisons to other tobacco companies. All of the other ones spent no money on research and had no issues with the dollar. So Philip Morris really reached for this product, and they had enormous ability to suffer. Now, fast forward, the product has been launched, and in the first quarter when it was launched in Japan, the first market, they sold 400 million units. This year, they'll sell 36 billion. 400 million to 36 billion. It has gone from, I can't even read it there. It has gone from 64 million in revenues to 3.6 billion. It's now 12.7% of total net revenues for Philip Morris. It's now it's up higher from December to today. It's now 16% of the Japanese market. Now, mind you, the people who have converted to the use of this product do not relapse back to tobacco, and this product does not recruit kids. unlike, the things that the vapes and other things that sort of, that offer flavors and other devices that attract kids. And what's happening now is they've reached over 5 million consumers. They think that the product will get to 250 billion units by 2025, and the traditional cigarettes will drop from 800 billion down to 550. I suspect that if it continues, it'll be far higher on the new product and far lower on traditional cigarettes. I think the rate of abandonment will accelerate. And now they're going about the rest of the world, and they have to invest a lot up front through boutiques so they can introduce people on the product, and that upfront investment obviously is part of their capacity to suffer. Other people chose not to make those investments, and nobody else has anything remotely close to 16% of a market share. They've taken the same approach to different markets, and you can see. Well, here's Greece. It's the third one over. It kind of languished for the first 3 quarters, and then a massive jump. And I would not be surprised if at the end of this year that it'll be up over 6 or 7% of the market total. Where's Korea? Korea as well was a market that was launched in the second quarter of last year it had 0.2% market share. It's at 7.6%, and could very quickly get to 15, tracking Japan. Now, there's nothing that's been like this. Now, and just to give you a flavor, though, of how it is to be an investor in a business like this, this afternoon, the FDA in the U.S. announced that it was their belief that they were going to create an industry requirement that cigarettes have lower nicotine. Well, if you make cigarettes with lower nicotine, the only thing people will do with those is smoke more of them, because they have a desired level, and if the government says you can only sell cigarettes that deliver a certain level, it's a bit like markets in the U.S. where you're only allowed to sell 3% alcohol beer. It's a pretty quick math. You drink 4 more than you would otherwise, and so I mean, but the politics behind this stuff is just so excruciating. They actually have created a product that allows people to quit smoking. 5 million people have quit in Japan. That is extraordinary. Nothing has done anything remotely close to that, and those are now off the risk factor because they don't get combustion. The U.S. FDA has found itself entirely flat-footed and out of the game because the thought leadership now is on these reduced risk products and the kind of conversion that they're getting. So they come up with a Hail Mary to talk about reduced nicotine regular cigarettes to try to gain some relevance in the process. But the truth is they have a decision to make as to whether or not they'll let the company that makes that IQOS in the North American market, when they go to market later this year, tell the consumer that it is a reduced risk product when compared to the traditional cigarettes. And the FDA has the ability to say, you can say that. And in fact, it's true, the 95% reduction because there's no smoke. But the fight over tobacco in general has been so long-standing, and the lines are so so definitely drawn, that it's not clear how they'll treat it. I think Philip Morris has done exactly the right thing. They invested an enormous amount at a huge expense to the workforce, and we'll see. So, I'd say let's go back a little bit. The last point about this investment world is that the portfolio manager has to have the capacity to suffer. And if you look at this table, you will see that in the year 1999, Sempervic Partners was down 2%, and the Dow was up 22, and the S&P was up 27, and we did not have a massive amount of withdrawal of capital. even though we are massively out of step with the market. But the message from that period is to look at the performance relatively in the 4 successive following years, and you'll see that our portfolio was more like a coiled spring than it was a leaky balloon, and the 4 years that followed, we gained an enormous amount of advantage. And so what you want to think about as a money manager is to make sure that you don't find yourself in a position where you're forced to act because your investors become frightened and nervous, and mostly nervous about not making money when crazy things seem to get everyone rich. And Jeff and I talked about that earlier tonight. How do you go about managing your investor expectations and recruiting just the right type of investors? And so, but the notion of the need for that capacity to suffer, and as recently as the last 3 years, when the S&P was the only game in town, it was outperforming, and we did not suffer great withdrawals because we tell our investors at the start that there's absolutely no way to time when results happen over time, sort of in any given time. But there is a belief that you can find businesses that will be able, like Heineken has and Philip Morris has, to deliver results over time. One of the things that I think has given us the capacity to suffer as an investor is we don't have something that is very difficult because it's very alluring. So many investors have a fee structure of 2 and 20, which creates an expectation among investors that they are going to be clearly superhuman, and superhuman enough to absorb the huge burden that 2 and 20 generates. And so we charge 1% advisory fee. That's it, and we sort of convince our investors to have very low expectations of what we're about to accomplish on their behalf, and I think that's helped us a lot over the years. So the most important message I'd leave you with is that the number one cost to investors is agency costs. It's the willingness for most public companies to be managed for the far too near term. Options play a role, and the lack of the ability to defend against Wall Street when bold steps are needed means that most companies can't. Those who are protected, as what I think are the companies that we have found, Berkshire's the leader in that field, but there are others, tend to be family controlled. They tend to be able to call their own destiny, and they tend to invest a lot up front. And then they gain competitive advantage later on because others who they compete with didn't have the flexibility. And that's what we stand for. So, any questions?
You gave an interview recently about Mr. Buffett, and you said that Mr. Buffett is going to be able to put tremendous amount of cash to work, possibly soon. So what do you think he's going to do?
Well, I think what I wanted to make sure people don't forget is that you never really anticipate where the next pitfall will come from, and there will be a time, in the unraveling of our investment world. We've had extraordinary investment returns over the past 6 or 7 years, and they're all built upon this very low interest rate base that we've enjoyed. And we're going away from that now, and it's not at all clear why things should be presumed to be smooth sailing going forward. But when people project fear over Warren's ability to deploy that capital, I think they mistakenly view that the world will be a pretty steady place, and that's not been the history. And for Warren to have all that cash available at some point in time, I'm sure it'll be valuable. I can't tell when or what will be the catalyst.
Is he making decisions, or he passed the decisions to the other, I guess, Abel or Jane?
Well, clearly with, I don't know, is it $25 billion in newfangled businesses like Apple and, we'll just say Apple. I suspect he's itching to buy Amazon and has entered into a partnership with Jeff Bezos, a big, the healthcare, captive healthcare partnership. He speaks highly of Bezos, and he recognizes the grip that company has on retail. Witness the fact that he sold his enormous position, maybe $6 billion worth of Walmart, not that long after the annual meeting last year, when he extolled praise on Bezos. So, but there are long-standing areas that both Ted and Todd had worked on for a long time that relate to Apple and other businesses that are more technological. And if Warren's going to invest serious and large amounts of money on those, I guess the support's going to come from the two people who've spent a lot more time with technology. But I do think that he's elephant hunting, no question about it. And if he were to find a traditional company that had need to partner with him, the best answer for that is what Berkshire is going to need to continue to succeed is what Larry Cunningham talks about in Berkshire Beyond Buffett, where he talks about Berkshire being a place for people with the best businesses in the world who, if they need to sell, will naturally be inclined to come because he provides an ecosystem where great businesses are allowed to continue unchanged. And the alternative is private equity. And the moment you sell to private equity, they're beginning the sales process for taking that business public or to sell it. And so, Berkshire offers a tremendous home for great businesses. And those businesses, I would suspect, are going to be more like the ones that Warren would be the one who welcomed in. But the FANGs and whatever involvement that Berkshire is going to have in that area of technology, I would suspect is a younger man's game.
Kind of talked about the capacity to suffer. How do you identify sort of management being exuberant with sort of the cash that they gain from the operations? Because, in terms of the quantitative side,
Yeah.
The numbers would reflect that they can be sort of exuberant, right?
No, it's a very good question. And I think of an example, which was a company that I owned a long time ago. It did very well for a long time. Then it became trouble. It was called International Speedway, and they owned NASCAR. NASCAR is a Southern thing, and people drive cars fast, and they drink beer and smoke cigarettes. And it's absolutely revered. And International Speedway came public and has across shareholdings with NASCAR, the sponsoring body. The France family owned all of NASCAR and a controlling interest in Speedway. And we invested in Speedway, and it grew across the regions and grew profitably because they were opening up new markets and creating new venues, and they owned the right to the tickets and everything else there. They spun a lot back up to the parent. But it turned out that they exceeded the natural market. But it didn't mean that the parent, which was the France family, didn't still want to pressure the public company to make big investments because the family profited. So it got to the point where they were trying to put a $500 million speedway on Staten Island on a toxic waste dump. And at that point, that was such a bad misapplication of cash flow that we sold the company, our shares. And we've never looked back because what became apparent is that there are different levels at which the family would personally profit, and by focusing only on growing the category, even if it may lead to low returns on the public company, they would make more money. It's a lot like the Coca-Cola bottlers have a conflict with Coke, the concentrate, and so. Now, if that business had found itself into Berkshire, for example, the perfect solution, and this is what makes Berkshire so powerful, is if you don't have something to use the money for, send it up to Berkshire. And if you're one of those divisions within Berkshire, you're not forced to spend money. If you can pencil out a good return, there's abundant, limitless amounts of money to spend. And in most companies that aren't as thoughtful as Berkshire, they end up with things like that International Speedway situation. And at that point, we sell the stock when they're making really dumb redeployment.
How do you, as an investor, decide that the capital reinvestment is in the right project? Because most of the times we get to know in hindsight or after the fact that the project was not successful.
Yeah.
One of the markers, I think, is, for example, a company like Philip Morris is ready to disrupt its own main line of products with a product before competitors come in. So do you think that's one of the signs, or what are the things that you look for when a company, reinvests its capital?
Well, obviously what I started with the conversation about the early days of this European-based portfolio, where it became exciting to me was when they realized that they could take their free cash flow from the mature West, where they really couldn't effectively deploy it. Now, that's not entirely true because, for example, Heineken, over the past 20 years, has closed down 45 different businesses, building structures in Europe, as the unified market allowed them to put warehouses in a more appropriate spot, and everything was done jurisdictionally in a kind of balkanized manner historically. But over the past 20 years, Heineken's had a huge return on the investment that they spent, smoothing that footprint and making it all more effective. And so that we've been able to track that investment with our conversations with the company. They talk about it. It's open. The benefit of it, I think, is higher than the market believed it would be. But the best investments are sort of the Nestle rolling out a new product called bouillon in a market that's ready for it, and doing it at scale, so that if they spark the interest, that nobody else will get to take the business. And then they get first mover advantage. We like that.
My question is, how do you choose an appropriate discount rate? And I guess with these companies sort of like in Europe, like Nestle in Switzerland, if you're using a long-term bond yield, do you use like where rates are at right now? They could raise capital in a multitude, I guess, of countries. How do you sort of think about that when you're discounting cash flows?
Well, it's extremely difficult because, as you say, you're borrowing in different currencies, different maturities, and for different projects. But Buffett has always said that he sticks. I think he said at 7%, and as interest rates go down a lot lower than that, at least I don't follow those downward because they'll give you ridiculous valuations, and they're probably not to be relied upon. And so, but we live in a time when there's so much financial distress that's been masked over by low interest rates that we take for granted these low rates, and I don't trust them. There is the reality that our feeling good recovery in North America, at least in the U.S., has come massively at the expense of elderly savers who would have planned their lives for a retirement with a $100,000 8% CD, and it's rolled over since 2010 at 0.5%, and that's it. So I think the pressure on interest rates will keep you better off by not following the current rates down as low as they've gone.
Hi. So just in the kind of manner of capacity to suffer, how do you manage your own behavior as well as the behavior of your unit holders, especially in times where things get really difficult, like in 2001 or in 2008? We went on safari, so, but that really wasn't very useful because I was on the phone the whole time. I think it's to be very clear with your investors from the start that you're in it for the longest term, and that there are lots of moments along the way, but your focus is long term, and that remains. And you can make moves during periods of great stress that might improve the forward-looking component of your portfolio, and so you should be very active in revisiting. And if something's prospects diminish because of the swirl that you refer to in sharp market retrenchments, you probably well served to make some moves, and so we do that either on a small scale or a large scale, And then it's the same question that Jeff and I were talking about before the meeting, which is how do you make sure that you have the right investors? And for me, what I've typically done is I've ended up managing a very small portion of my clients' funds. And so, I'm not of the emotional awareness that makes them so frightened that they literally have to sell when things are going down. I don't give them the benefit of the discipline that investors try to do. But I mean, when investors panicked, there's very little you can do to stop them from making moves that will harm them long term. And so, and as a money manager, if you have that risk, other clients of yours will suffer as well because you'll be forced to sell things that they already own. So.
Hey, Thomas. My question is, coming out of undergrad, was this what you expected to do? And what are some things that you wish that you had known starting off your career?
Yeah, I had early models in our family of investors and people who had a interesting balance. I wouldn't have spent the extra years at law school because I did spend 4 years in graduate school. But I think the legal perspectives added a lot of understanding to some of the factors that have been quite important in our investment universe. So I don't begrudge the legal. Maybe sort of a bit more open-minded of the earliest days of the FANGs, because I would just bring to everyone's attention, there's no one who's had the better capacity to suffer than Jeff Bezos. In the history of mankind, nobody's been allowed to lose more money on a regular basis by shareholders who give him the capacity, and nobody's been able to build a stronger franchise in some manner as a result of that than has he. So I probably should have been earlier and more thoughtful on it, but I just took the cue from everyone else who said, I don't do technology, therefore it's technology. That's probably a mistake, because I could have figured out some aspects of it where it really is just a story about massively focused on consumer utility activities that he's done an excellent job on. So probably to have missed. And mind you, all the FANGs have control shareholders. So if they want to invest at deep losses to develop, Amazon Web Services or cloud services, for example, they won't lose control of the company. And that was a big, powerful benefit, and I didn't invest behind those aspects.
Thank you for being here. I want to ask a question about when I ran through your portfolio, I see 8 companies, and basically you buy almost the whole industry. For example, in tobacco, you buy Philip Morris International, Arncia, and BAT.
Yep.
So basically you buy the whole industry, or for example, for beer, you buy Heineken and Busch InBev, right? And
Yeah, I
3
think
companies
sounds
for white spirit, Pernod Ricard, Diageo, and another one, Brown-Forman. So what's the benefit of buying the whole industry, almost about buying the whole industry? And so the second question is, when you think about brands, do you think of bad human behaviors? If they don't smoke, they drink beers or they drink white spirit?
Let me understand your question again.
The first one, you buy the whole industry.
Yeah. Well, one of the things about the industries is that they tend to have this extraordinary relationship with the consumer where they develop brand loyalty, and the consumer doesn't believe there's an adequate substitute. And one group of consumers feel that way about Jameson's Irish whiskey. Another feels that way about Johnny Walker Black Label. It certainly has an enormous following in India. Another one feels that way about Martell Cognac. That's Pernod Ricard. And it's a privilege to have the opportunity to deploy capital across those different companies, because each one of them, because of their exposures, their brands, and their geographies and all the rest, come back to us with a different blend of returns than, for example, if all of them were just in one company called Pangea or something. You pull all the spirits companies together, it would be a different investment than what we've got. Each one of those has a unique portfolio, mix, and capital structure. and all the rest. And so I'm delighted to have a chance to own multiple expressions of the same business, and in fact, hold myself back from buying more spirits companies right now. And the second question was what?
The same question, like, because like three companies like in three industries, so basically people either like smoke or drink beer or drink white spirits. So when you think about brands, you always think about bad human behaviors? It always like.
Well, I haven't. I mean, if I felt that, that people who go to the library on Friday night have sort of a commitment to that in a way that I could be involved with, and they felt similarly passionate about the relationship, if there's some way to get involved, I would. But the trouble is, I mean, these are the businesses. And by the way, just to be clear, society knows that of those businesses, that they do have these extraordinary loyalties. And guess what they do about it as governments around the world? They tax them. They tax them up to the gill. And so the implicit question, I think, behind the question, sort of implicit point behind the question is, what about something that's not bad for you? Would you think about other things that aren't necessarily bad for you? And the one thing I'd say is that the businesses that we do on, whether if it's a cigarette company or it's a beer or a spirits company, the government is taking a whopping amount of the business away from us owners. In New York City, it's $14 for a pack of cigarettes. The manufacturers get $1. All the rest is state and local excise taxes. Now, at $1, they may make 80 cents per pack. They may have 80% gross margin, so they still are okay. But you can imagine how much is dependent, how many different interests are fed off of that business. And what we have to worry about is that the effort to pile on more and more and more claims against our businesses, because at the end of the day, the goal there is to keep raising taxes up to the point where it becomes revenue decreasing, and at some point there'll become income elastic, price elastic demand, and people say, I can't buy that anymore. And that's ultimately where society sort of taking these things, and the revenues go to all sorts of social programs.
Hi, could you maybe run us through an investment you made that you met your criteria for price, quality, and had all the hallmarks of a great investment that didn't quite pan out as expected? And what do you think you may have overlooked in retrospect or might have missed in hindsight?
Yeah, I mean, it is the International Speedway story. I mean, what I missed is that actually the family control was a negative in that business, because it put them on a mandate that's, I said sort of Heineken had no and yes and no. In the case of Speedway, it was yes, 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 yes. We just want to keep pushing money out into the creation of new tracks, and the family controlled that decision making, so that the public company was pouring money out into structures that kick back revenue, royalties to the sponsoring body, which is owned by the family. And so I think that there's a much more inherent pressure there. H&R Block we owned, and they misinvested their cash flow badly. And they bought into enormous amounts of trouble, and we finally sold the shares. What I missed there to begin with was that the lack of international investment opportunity made them landlocked and made them take second and third best choices, because they couldn't do what would be very natural, which is roll that product out around the world, because nobody else has our tax code. And in most of the world, nobody pays taxes. Like India, and they would love to have that tax processing software in India if it meant that somebody would pay taxes. Those are my main thoughts.
And just another follow-up question. So you guys probably looked through a number of investment ideas.
Yeah.
And over the long career you've had, what would you consider the one investment you were looking into very seriously but didn't end up purchasing as like the one that got away? And why didn't you decide to purchase it at the time, and why do you wish you had purchased it?
Well, I'd probably go just straight back to Google for me, because it's entertainment, so it's got advertising. They have leadership in search. They have control over their destiny massively, and so they're able to do what they choose to, regardless of the sacrifices to profitability. And I didn't invest early on because of the rumblings and threats and actual filings of lawsuits against them throughout Europe for anti-fair trade practices. And I thought that they'd get hung up on that, and they constantly were able to kind of elude those risks, and the business has just grown mightily, and it's still a pretty powerful business. It's just gone up a lot since we spent time with it. So.
And just one final question, and I promise I'll stop talking after this, is some value investors say that tech stocks and value stocks are inherently two separate things and that things don't overlap. And then interestingly enough, you just brought up Google. So my follow-up question would be, what would you say to the critics that argue that value stocks cannot be tech stocks cannot be value stocks?
I think my mistake has been to understand what the actual product is. So Amazon, was one of those businesses where I and lots of other people just said, I don't do technology. I can't understand it. It's too fleeting. The franchise is eroded because of next technology. There's no presumption why this and that would be successful. And it turns out that he does an Amazon cloud service business, and suddenly, it's a huge subscription business, and off it goes, and it has very little to do about driven primary technology. It just has to do with server farms and capital deployment and operational logistics attention. So it's not deep. It's not deep technology, other than the data analytics, which are hugely important for the consumer business. And so I think the technology that they deploy gives them huge competitive advantage, but I don't think that they're leaders in technology. They ask the right question, and they use technology to help them answer it.
Hi, Tom. I have two questions. The first one being on, family-controlled businesses and management succession.
Yeah.
When you're dealing with companies that have so much control, how do you see the risks of management succession and, the importance of good succession planning?
Yeah, it's handled differently by our portfolio companies. In Heineken's case, Freddie Heineken, this is sort of the dynastic view that I find appealing, was asked in 1986, why does he still work so hard? And he pointed to this little boy playing in a sandbox just beyond the view, and he said, I work so hard so that his grandchildren will be rich. And of course, that dynastic kind of view is what we like to align with. That young boy now is 35 years old. His name's Alexandra, and he could have gone into the company, but he went instead to Lion Capital, where he bought Weetabix from me, ironically, because that was a private equity firm. And he spent 5 years in the private equity world in the consumer businesses, private equity consumer, and he's developed a whole toolkit, but he's not going to go operate in the company because the observation there is that even if he was as good as he could have been, the mandate that he would get would always kind of be questioned as to whether it was blood rather than ability. And at the same time, that if he did rise up the ranks, the family would worry that if he wasn't actually that good, he would never fire himself. And so the family sort of encouraged him not to enter the fray, but rather to serve on the executive committee, at which point all of his talents, sort of looking at businesses, can be applied towards thinking about Heineken strategically. Alexander Ricard, by contrast, when his uncle died prematurely, became chairman and just CEO, and will do so probably for 30 or 40 years if health permits, because that's kind of in the history with the Ricard families. They have a family patriarch who's the operating CEO, and he's certainly
talented enough to carry the mantle. In Brown Forman's situation, which is a business that we had for a long time, there are no members of the Brown family operating the company at the moment. And actually, they've had an anti-nepotism rule for a long time. So, it varies. But in each case, there's a huge effort to try to make sure that the family councils get the family members together frequently, and so create a kinship and an artificial continuity with each other, because as people scatter around the world, there's not the natural affinity towards shared outcomes that would have happened historically. And so all those companies have very active efforts underway to have family symposium and places where they can reflect on their shared destiny.
And as a second question, and some students here at Ivey have the opportunity to do what we call a dual degree program. I guess in your case, it was a joint degree program.
Yeah.
How have you seen the benefits of multidisciplinary programs? Like, what benefits have you seen them having on
Well,
the
for
way
you, one of them would be just exactly as it was for me. You get to spend 2 more years in this beautiful place and hang out with smart people. There is a huge value in having a variety of different areas that you're familiar with, and what would be the nature of your?
It's in computer science.
I would think that will be valuable in any of the areas that you'd end up in as an MBA. And I mean, I just met with the head of Brown Forman's international business last week, and I was talking to him about somebody who wanted to interview there, and he said, well, what I really want are MBAs with computer science skills. So if you want to go work for Brown Forman selling Jack Daniels around the world, let me know and do that second degree. Because his point is that we actually need that extra set of tools to either manage the process or involve themselves in it directly. But it's the blend between being trained fully as an MBA plus having deep computer skills is what they found intriguing.
Thank you so much.
You bet. Oh, I never looked over here. So, do we have any latent?
I think everybody goes there.
Oh, okay. All right. So no questions from left field, so they say.
At the end of your most recent letter to investors, you highlight some of your favorite Charlie Munger epigrams, including "A stock does not know that you own it," which he makes to caution against commitment bias and emotional attachment.
Yeah.
So I was wondering what you think is your most significant personal bias as a value investor, and what kind of processes you have in place to counteract that bias.
Well, it's clearly a commitment bias. I mean, I sort of worship at the altar of all of these companies every minute of my waking hours. So, and I know it to be the absolute case is that as long as I don't own something, everything I read about it affirms my decision not to own it. The moment I own even a single share on behalf of a client of that same company, the next eternity I will read everything to try to justify buying more of it. So, I mean, it's just amazing, but it's true of me. So then the question becomes, how do I steal against that outcome? And I have colleagues with whom I work. We talk about our businesses, and I guess if the bias becomes harmful because the businesses become overvalued or they operate poorly, but I'm blind to the performance effective poor operators. If that's the case, then I have people I work with who sort of say, Tom, wake up. You're missing out on the fact that these guys who work at Heineken don't show up to work anymore, or whatever the observation might be. But I really do have what I think is a very healthy case of commitment bias. Now, I'm going to spoil that answer a bit because the field of behavioral finance obviously would love me not to have any bias whatsoever. And what I would simply say is I think most of the issues that surface in the field of behavioral finance become ever more important the shorter your time horizon is. It's things like, earnings reaction. You know, if there's an earnings that you think is coming at the end of a week, there are all sorts of steps that investors take that really are only important if your time frame is quite near term. But to have commitment bias on a business that you're going to hold for 40 years, probably is a little different than the kind of, it just seems to me to be consistent with how you might feel about a business if you owned it yourself. I mean, the trouble is in the world of Wall Street, you might think that's a negative to have commitment bias. But if you own the business, if you own Heineken yourself, you probably would go around telling the world just how happy you were. And in Wall Street parlance, that means commitment bias, and you can't make an honest trade. But if you're going to hold it for 40 years and you want to celebrate it, which is what we do, I think you can get a return from that, particularly for us when we end up intruding on the companies and say, by the way, you should spend even more. Don't worry about Wall Street. Spend more because we want to make more later on. And so if you're going to have some kind of a ongoing dialogue with the business managements, and what you're trying to do is extract from them even a bigger commitment for more later investments. I don't think commitment bias in that world would be a particularly dangerous consequence, nor would it have been if you owned the company 100% yourself.
So we're running out of time. Last question,
Yes.
Tom. What is the most important thing you learned in life and investing over the last 40 years?
Well, I could probably spend 40 years trying to think of the right answer. In investing, I think in all cases it's going to have to do with staying true to your word. If you say you'll do something, do it, and people will grow to understand that you're reliable, and then from that an awful lot can flow. But if you can't start with that level of personal integrity and reliability, it's hard to sort of channel your progress from a start where you don't have the ability to make sure that your yeses mean yes and your nos mean nos, and you actually stand for something. So, thank you.